M&A transactions can be complex and often confusing to a first-time seller. One of the most misunderstood topics in the process of selling your company is working capital. Working capital is simply the capital used to fund the daily operations of your business. These are often known as cash, accounts receivable, inventory, accounts receivable, payable, and others. For decades, owners have mastered the art of cash flow and working capital in their business. Business owners can often be heard telling their friends that cash is king. The complexity comes when determining the proper amount of working capital to transfer to a buyer. Most purchase prices for the sale of one's businesses by applying a purchase price multiple to adjusted earnings. Often, the seller's working capital assets are important to determining the buyer's leverage and the ultimate purchase price. M&A transactions are commonly negotiated, assuming that the seller retains the cash within the business and retires any interest-bearing debt. At closing, the buyer typically assumes the assets and certain liabilities of the business. Since the working capital of the business fluctuates on a daily basis, it is often tricky to ascertain the proper amount of working capital to transfer to the buyer. The working capital adjustment mechanism is designed as a fairness mechanism between the buyer and the seller. This tool is a critical part of an M&A process to ensure that the seller is not motivated to accelerate or delay the payment or receipt of working capital accounts. The process can be broken into three distinct phases. First, setting the net working capital target. Second, estimate the net working capital at close. And the last and final step is the verification of net working capital accounts, typically 60 days after close. Setting the working capital target. The first step in the process is to negotiate the proper net working capital target, which is often referred to as the PEG. Simply, this represents the net amount of working capital promised to be delivered to the buyer at the close of business. The calculation of working capital is a simple math calculation involving working capital accounts. The working capital accounts of a business can be summarized into 5 primary asset and liability accounts: accounts receivable, inventory, prepaids, accounts payable, and accruals. Of course, many different types of account balances may come into play for your particular business. The historical balances of these accounts are examined to determine patterns in the balances. In the event that your business is rapidly growing, the buyer may contend that the most recent last 3 months' balances are more representative of the working capital expected to be delivered. Typically, buyers and sellers agree to the average last 12 months' account balances to establish their working capital target. The illustration on the screen shows the typical calculation. It entails gathering the last 12 months of balance sheet account balances and determining the average amount of net working capital for the 12-month period. Subsequent to the buyer's diligence and quality of earnings analysis, the buyer may have modified account balances to include in this analysis. Typically, GAAP accounting standards are expected in this analysis. Estimating the net working capital at closing. During the days preceding the close of a transaction, your advisors will assist you in determining the estimated working capital balances on the date of close. Often, many of these account balances are not easily identifiable, and estimates may need to be used. It is important for your advisor to play a role in the normalizing of historical account balances to properly reflect the cash flow cycles of your business. Your estimated account balances will produce a net working capital balance at closing. The previously calculated target is compared with the net working capital at closing to produce a difference. If the net working capital at closing exceeds the net working capital target, then the buyer will pay the seller the difference. The additional payment will be treated as additional purchase price, including the closing wires. It is important for business owners to continue to operate your business in the normal course. The desire to collect your receivables faster will not yield the seller additional proceeds. We often provide the advice to our clients that the calculation, it is what it is, and the working capital mechanism will protect both sides from changes in working capital. This mechanism is merely a tool to ensure that both parties are treated fairly throughout the purchase process. Verifying net working capital, the final phase in the process. We've set the target, We've calculated the balance at closing, and now the accountants come in 60 days later to verify the balances in the net working capital accounts. The terms and formal working capital calculations are specified in detail within the executed purchase agreements. Within this agreement, the initial estimates of net working capital are to be verified to the buyer's accountants. The verification of the final accounts may reveal that the initial estimates were different than the verified balances. In the event that the balances are different, the buyer or the seller will send a check to the other party. It is important within the documentation of net working capital that all parties are very clear as to what's to be included and excluded from the calculations. By having proper documentation at the letter of intent, and by including that into the purchase documents, it makes it easy for all parties to know exactly how to verify these working capital balances for the final calculation. Hopefully this session and these conversations have been helpful in your understanding of working capital. EdgePoint Capital is an investment banking firm based in Beechwood, Ohio that specializes in helping business owners through the process of selling their company and dealing with issues such as working capital.